Hey everyone, my name is Sean, and in this video, I'm going to give you an update of my PeerStreet and M1 investing portfolios. And I'm going to give you the exact method on how I evaluate stocks to add to my portfolio. So before we get into it, my channel is all about investing, passive income, and option trading to help you earn money. So let's get on into it. Here on my screen is my PeerStreet Dashboard. And you can see the usual details. Here's my account value. I have about $6,000. And you can see that my simple earnings are 8% annually. And cumulatively, I've earned 23%. And my total earnings since 2016 has been $1,400. And we're going to positions right here. And these are my active investments. Right here, I have 6 open active investments. You can see my investment, my principal, my rate, my earnings. And these earnings, this is powerful, right? This is income that I'm earning without active management, really. This is active income that's coming in every single, month. And then you can also see my start date, maturity of my loans, and the status of my loans are all current. And you can see right here, here are my transactions from November 13th, 2019 through October. And I touched on this on my last video where one of my default loans got paid back and all the interest got paid all at once. So you can see it's quite funny. October, September, August, July, June. All the months I didn't get paid for my default loan got paid off at once in October. And it was quite nice to see and gave me more confidence in PeerStreet as a platform, because I was kind of worried that my loan wasn't going to be paid back. So anyways, let me show you my account statement real quick. And here is my PeerStreet statement. And I blocked out some of the sensitive details, but I just wanted to give you, just how much I earned in this period, which was $102. And this $102 is quite a bit compared to what I usually earn. And that's because of that outstanding loan that I had. So you can see right here, this loan got paid back. So $70.25. And this is why I have such a high earnings this statement. Here's my M1 Finance Dashboard. And you can see my account value is $4,200. And since May 6, 2019, I've gained $320. And most of this is market gains. And as a dividend investor, I earned $64. And this number is so great. This is passive income that I'm earning. And this is just so fun to see, right? You can see my activity right here, and you can see all my earned dividends right here, right? This is just great. I don't have to do really any work for this, right? The only really work I need to do is researching companies and making sure that none of these companies cut their dividend. Because if a company were to cut their dividend, that would be a bad sign, and I would strongly consider selling that company. Now, going back to my portfolio and going into the different slices of my portfolio, you could see that I made all these smaller pies into my main portfolio, right? And this is just all to diversify my portfolio, right? And you can see right here in consumer, you can see I own like 6 stocks, right? I own Disney, Home Depot, Costco, Nike, Comcast, right? My 3-part method on how I evaluate dividend growth stocks is: first, I analyze the company. Second, I evaluate their financials. And third, I look at their growth. So taking a look at Disney, right? There's no need to explain this company. Everyone knows who Disney is. And that right there is the reason why I invest in this company, right? They are a well-known brand. And what they have is a moat. And I don't mean a physical moat that keeps their competitors out. I mean, they might have one at Disneyland, to keep their competitors out from their brand. But that's not what I mean. I mean is that they have an economic moat which protects the profit of the company, right? For example, right, they have a theme park. Another company would need a lot of money and time to build a theme park just as good as Disney's. And this right here is what keep their competitors out. They also have a lot of intellectual property and well-known brands such as, Marvel, Star Wars, Pixar, right? And they can use this content to make movies. They can, to sell toys. And they have so many ways to earn money. And just recently, they just came out with a new streaming service, Disney Plus. And they've added 10 million subscribers to the streaming service. And that is a lot of money that they're adding to their revenue. And this is why I'm really confident in Disney, and this is why they are a part of my dividend investing portfolio. So next, we're going to take a look at the financials of Disney. So first, I just look at a 5-year chart, right? And I just see the trend, right? Are they increasing in value? And that is a yes, right? They were going sideways for a while, but with their new streaming service and all the different ways that they can make revenue, I see the stock just going up. Next, I look at the actual financials and their total revenue. And annually, I see that their total revenue is increasing year by year between 2018 and 19. I mean, look at this. Looking at total revenue is a quick, easy way on how to evaluate the financials of a company, right? I mean, you could dig into here and look at all this other stuff such as income, reported EPS and interest expense. But just looking at the total revenue, if they're earning more money each year over year, that is just a good sign. Sometimes, their profit can go down if they bought a brand, right? And that doesn't truly reflect how much money this company is actually making. So that's just a quick, easy way kind of how to evaluate the income of a company. Next, I'm at Seeking Alpha, and I'm looking at the dividends of this company. And I like looking at the payout ratio. And what this payout ratio is that it is the percentage of the income that a company pays out in dividends to its shareholder. So usually, like, the lower it is, the safer the dividend is, and the faster that this dividend can grow over time. But if a payout ratio of over like 80% is generally a red flag. But even that is just kind of a rough benchmark. In some industries, you don't really want a payout ratio above 50. And Disney has a payout ratio of 32%. So 32% is the income is paid to a shareholder through dividends of their income. And a consideration when buying a dividend stock is the safety of the dividend. So when buying a dividend stock, it's absolutely crucial that you don't really go for high yielding stocks. It's not good to focus only on these stocks. A high yield often shows that investors are kind of skeptical of the company's ability to sustain the dividend, and that it may be in danger of being cut. That skepticism drives down share price, and a lower price pushes the yield ratio higher. And if the dividend market thinks that the dividend will be cut, and it is cut, the stock will go down and you lose your money. Plus, you'll have a smaller dividend. So you kind of lose in two ways. And next, I like looking at the dividend history. And looking at all, you can see since they started paying out their dividends in about 1990, you can see that it's been steadily increasing, right? They haven't had a cut in dividends or stopped paying out their dividends right here. And so this is a good sign for a dividend stock. An example of a company that cut their dividends is General Electric. And if we go over their dividend history, and looking at all, you can see right here, 2009, they cut their dividend drastically, right? And they slowly been increasing dividend and been cutting and cutting. And you can see in the summary, around 2009, right? This is a bad sign, right? The share price started decreasing in 2009. And they've been slowly just increasing. But that was just a sign that it was time to cut this company because they're having trouble paying their dividends. And this is why I strongly urge that if a company were to cut their dividends, that you should consider selling them. And lastly is the growth outlook of a company. So you can see here in this Wall Street Journal article right here, Disney reports 10 million users for its new streaming service. I mean, holy, 10 million new subscribers for the company, right? Not only does Disney have like their theme parks and their movies and all their products and toys that they sell, now they have a new streaming service. And this company has room to grow now. Not only does Disney have the revenue from this new streaming service, they now have people's emails. And they have data on what their customers like to watch, right? And what Disney can do is like collect that data and see, okay, this show is really popular, so we're going to make a ride based on this new show, and we can sell products and attract more people to the parks. And it's just a whole ecosystem that they have, right? And it just kind of feeds upon each other more and more. And this is why I'm really excited for Disney and their growth opportunities. And this is the last factor of why I'm really confident in this stock and it being a part of my dividend growth investing portfolios. So that's it, everyone. That is my 3-part method on how I evaluate stocks to add to my investing portfolio. First, I figure out how they make money and I understand the company. And second, I look at their financials. And third, I look for their growth opportunities. So that's all I had. If you found this video valuable, just do the usual social media stuff, like the video, and subscribe if you want more investing videos to help you earn money. Take care, investors. Bye.